Let's bring in KBW's head of U.S. Bank Research, Chris McGratty. Chris, great to have you on. It's really interesting because maybe a big consensus trade was to own the huge banks coming into this year. Not a lot to really get too alarmed about at all in the results, but it seems like it's been an excuse to rotate, because I'm looking at the regional banks up more than 1% on the day.
Well, hey, Mike, thanks for having me back. I would agree with you. Strong results, but high expectations. And so what you've seen this quarter is really good capital markets. We've seen really good loan growth. We've seen pretty good credit, but the expectations were high into the quarter. And then on Monday, you saw the sell-off begin in the banks, given some of the political risk that's happened over the weekend.
And do you think that this is just a kind of a stutter step in the big banks, the universal banks, or are we going to have to be a little bit in wait and see mode just to see if, for example, the deal calendar gets much busier, how the trading environment evolves?
Yeah, I think we're really confident in the capital markets calendar. Banks this week have talked about the pipeline for investment banking being materially higher year on year. Trading revenues are normalizing, so that rate of growth will slow. But the outlook for the economy is pretty good. Now, to the regional banks that'll start reporting later in the week, the real big picture there is net interest income growth. And what you see, I think what you'll see this week is you'll see pretty good loan growth, pretty good margin expansion, and top line growth.
And you mentioned the political risks. I mean, are these real risks in terms of, some kind of attention on credit card rates or other things, or is it jawboning that the market will be able to get past?
It feels like the latter. You can never dismiss, macro and political risk. But if you think about the proposal, right, everything's supposed to be helping the consumer and affordability. We understand that. We think that's a good outcome. But the economics of the credit card lending business at a 10% interest rate, it don't work. So what will happen is banks will stop lending in credit card, and so you'll see a pullback in credit extension, which I think will have the opposite effect of what the intended consequence will be, and that'll be slower growth and some economic concerns.
Yeah, I mean, I was looking at just some of the pure play card issuers, like a Capital One. I mean, it's not as if they have just massive, margins and returns on capital necessarily that you would think that they're kind of over earning in this world. So where does that leave you with regard to your preferences in terms of the names that are moving today?
So we're sticking with the universal banks. We understand this week's headline risks. They were the top performers last year. They outperformed by 25, 30 points. We think the fundamental backdrop for the universal banks is still quite strong. They're delivering, high teens return on capital. They're returning a lot of capital to shareholders, and they're still benefiting from deregulation even with this week. But we are being more sympathetic, Mike, to the broadening out of the financials trade. And so what we like to see is the net interest income growth, the stories there. Companies like Citizens and KeyCorp, they have really baked in net interest income growth stories. We'll start to see those results. And we also want to see the broadening of capital return. So beyond buybacks at the biggest banks, we want to see dividend increases. We want to see buybacks. We want to see mergers. And that'll flow through the entire banking spectrum.
Where specifically, when it comes to deregulation manifesting in this industry, are you modeling it out? Is it really in just in terms of, buybacks can be heavier, you can liberate some capital in that way, or are there other things in terms of, more loan growth or things like that that you think is really in hand here?
Yeah, the easy way to put it through the model, Mike, is to step on the buybacks. And that's what you've seen with the largest banks. You're seeing capital requirements come down. We still think there's more to go there. But you go down cap, you think buybacks, dividend increases, but the preference is to grow your company, right? That's the thing you're going to get a multiple for in long-term earnings growth is from growing your bank and growing your company. So we are seeing positive signs of loan growth, right? If you look at the H8 data in the fourth quarter, loans are up about 10% annualized. We're seeing it, the largest banks lean into the balance sheets more. I think what you're going to see over the next few days and in the next weeks, you're going to see pretty good loan growth. And that's a good use of capital, too, especially since capital levels have been fully rebuilt from 2023.